topic lah. So most important will be calculation of NPV and also other capital budgeting methods. So usually when we are talking about capital budgeting methods, there are some methods for us to evaluate a project or an investment to see is this project worthwhile for us to invest or not. Or pretty simple layman's term we use a method evaluate a project to see that is it is it a good project? Pretty simple. And like usual, I will give you the revision is quite long because actually from 2 topics, we combine to 1 tutorial class. So that's why please pay attention. And this chapter, I guarantee, I can tell you is a guaranteed to come out topic So in your final, definitely you will see 1 question from capital budgeting for sure. Okay, so please pay attention. Okay, for this revision, like what I said, capital budgeting, you can call them investing appraiser as well. So in our syllabus, we have 4 main methods, okay, to evaluate a project, which are ARR, accounting rate of return, or ROCE. They are the same. Okay, if you remember what I said, the only difference is ARR is something like your GPA, while ROCE is the CGPA. So ARR is usually for only 1 project. So if you combine all the ARR from all the projects of your company, it will become ROCE, return on your total capital employed. But they are the same. Okay, we have payback period, we have discounted cash flow methods, which including NPV and IRR. Okay, so you can say that we have 4 methods. 1, 2, 3, and 4. ARR, payback, NPV, and IRR. Alright, and in here, first thing you must know will be, in the 4 methods, okay, only ARR is a profit-based method. Profit-based method, it means that this method, when we calculate, when we are evaluating by using this method, is based on the profits generated by this investment. While all the others, as you can see, they are cash flow-based method, which means that payback period, NPV, IRR, they are all based on cash flows, not profit. This is the first thing you must know. I will tell the reason why. So when in the exam, if the question asks you to calculate for ARR, first thing in your mind is ARR is a profit-based method. Make sure you are using profit to calculate. While all the other 3 methods, again, like the question wants you to calculate payback period. First thing in your mind, payback is cash flow-based method. Make sure that all the figures given, they are cash flow. Because there would be a case that the question asks you to calculate ARR, but the question gives you cash flow. Or the question wants you to calculate payback, but it gives you the profit. It is possible in the exam. So when you see that, don't panic. Actually, very simple. Remember the golden thumb rule? Okay, let's say if you want to calculate ARR, but the question gives you something like the net operating cash flow 1 year is how much? From the question, you want profit, but the question gives you the cash flow. Don't panic. You just need to remember this formula. If you want the profit, you just use the cash flow, deducts any depreciation you can find from the question. Then you will get a profit. Because as you know, cash flow excludes all the depreciation, because depreciation, they are not cash flow item. So your cash flow is without any depreciation. But now if you want profit, do you need to deduct the depreciation? Yes, because depreciation is an expense. So if you want to look for profit, very simple. You use the cash flow given minus depreciation that you can find from the question. Then you get a profit. Or same things goes to like, you want payback period, you want to calculate payback period, but the figures given in the question is profit. Again, make adjustment. Because you know I want cash flow, profit is after deduction of depreciation. But cash flow, we do not include the depreciation, we do not need to deduct, we do not pay for that. So that's why we need to add back, use the profit, add back the depreciation to get the cash flow. Okay? So I repeat, summarize that. What you need to know from this slide, we have 4 methods. First thing you need to know is all these methods, they are what kind of method? Like ARR, make sure you know it's based on profit. Payback, NPV, IRR, they are based on cash flow. Why do you need to know that? Because like what I said, the question could ask you to calculate payback but give you profit, or ask you to calculate ARR, give you cash flow. So you need to do a little bit of adjustment here. It depends on the question. So first thing, ask yourself, like if payback period, look through carefully. Whatever given there, is it cash flow? So if the question give you cash flow, then no problem, you can proceed with the calculation directly. Follow the formula. But like what I said, if ask you to calculate payback, then very obvious the questions giving you profit, then you know that you need to make this adjustment. Okay, 1 minute for this one. Any question that you are having, you can ask. And again, this is like what I said, guaranteed will come out question in the final capital budgeting. For sure, you will see one question. Any question? No question, If you have no question, okay, then we proceed. Run later. Okay, another thing that you must know from this capital budgeting, we focus on NPV. Okay, because out of the 4 methods, I can let you know, all of them also important, but in case that if the question asks you ARR payback period, usually 2-3 marks only, because it's very easy to calculate. Like payback period, it won't be like 10 marks for payback, no. Usually only 2 marks. This one usually only 2 to 3 marks. So that's why I don't want to focus too much on that part. I will focus on NPV. NPV in the final usually about 10 marks or 12 marks for one question. Okay, so the following revision will be only for NPV because it's always the biggest questions from this capital budgeting topic. Now, while all these others, you can do your own revision. It's also important, like what I said, it's just that maybe the marks will not be that many. Okay, so for NPV, like what I said, first thing in your mind, cash flow based method. It is based on future cash flows, expected cash flows. Second thing you need to know will be, even though it's a cash flow method, but it doesn't mean that all the cash flows we will include in the calculation. So I told you all in the lecture class, this relevant cash flows concept is extremely important because it's not only for this semester. In the future, you will see NPV again for sure, and you will, see this concept again. Because in the NPV calculation, even though it's a cash flow based method, but it is not that all the cash flows we will include in the calculation. We include only relevant cash flows. So when you calculate, make sure all the cash flows, they are relevant cash flow. So relevant cash flow, we have all the following characteristics, you can say so. First thing, make sure it's cash flow. This one no problem. If the question you see, they give you depreciation, 2,000. Do you include in your calculation? No need, because depreciation is not a cash flow item. All right. While second is the future cash flows. I told you all before, we only consider future cash flows. Whatever happened in the past, there are sunk costs. So we do not include in our calculation. I think I have given you all this example before. So usually the question will be telling you, oh, now you are at year 0, you are considering whether or not to invest into this investment. If you invest, next year you get back 50,000. Okay, but the question also inform you that, this investment, you have already done research and development, maybe in the past 1 year, minus year 1. Minus year 1. Okay, so the past 1 year, you have already spent 80,000 for this investment. The question will tell you something like, the company has already spent 80,000 in research and development in the past year. Full stop. So now the question is, cash flow, you've spent 80,000 cash, let's say, for the R&D. Do you include in the calculation? No need to include. Don't include that in the calculation. Because why? We only consider future cash flows in our calculation. If you include this one, it will lead to a wrong decision. Reason very simple. You see, if let's say you are thinking like, hey, but this one also related to the investment, we should include. Yes, you can include. If you include, it will be something like NPV equal to discounted back. Maybe this one is present value already, already discounted to year 0 based on year 0 present value. Then your calculation will be 50k minus 80. This one is the money you get. This one is the cost that you have already paid minus that. And then the NPV will be minus 30k. Alright, then you say, it's not a good project, we should stop here. Stop, it means that year 0 you stop, you don't do this project. Is it a good decision? Definitely it's not a good decision, because you see, whatever you have spent is already past. You have already spent that. It is not refundable anymore. You get what I mean? So whatever you have spent, forget about that. When you are doing capital budgeting decisions, we look into future. If in the future I continue to do, I will get 50,000. Do you want to do? Yes, no, definitely you will proceed with this project. At least you can get back 50,000. If you stop here, your total loss 80,000. If you do, at least you can get back 50,000. Why not? So the decision should be, we should do one. So that's the reason why we only consider future cash flows. Whatever happened in the past, don't consider. It's already happened. Okay, so like what I say, it's not refundable. Forget about that. We just look into future. If can earn money, we proceed. Okay. The third one will be incremental. Okay, we only consider incremental cash flows. Incremental cash flows, it means we only consider those cash flows that is going to happen because you do this project. Because you do this project, some things happen, either cash inflow or cash outflow. It happens because of your decision. Then we include that. Those are incremental cash flows. While for those like you do or you don't do, it also will happen one. That one we call that committed cash flow. We do not include in the calculation one because it's not important. Because either you proceed or you don't want to proceed, if you happen somehow. For an example, I think I've given you this example, like usually the question will tell you something like the company has already signed a tenancy agreement, okay, to rent a factory which every year is going to pay 10,000 at the end of year for the next 2 years, and the contract is non-cancelable. They will tell something like that. It means that the question told you the company has already signed the contract, all right, for to rent a factory, let's say, for any R&D or manufacturing process, okay, and like what I said, the cash flow is in the future, so it is not past cash flow. It's not sunk cost. It is, you are going to pay that 1 year later at the end of first year and at the end of second year. All right, has already signed and is not cancelable. The question will tell you like that. So the contract is not cancelable. Whether you use the factory or you don't use the factory, you must pay. Okay, next 2 years, every year 10,000. And the question will tell you something like, okay, so now if we were to proceed with this project, we will use that factory. Now the question is this relevant? the answer is not relevant. Don't include in your calculation. Okay, because very simple. You ask yourself, if you do this project, do you need to pay? Yes. If you don't do you need to pay? Yes. You also still need to pay. It's already committed to that. So they are committed costs. Committed costs, they are not relevant. So that's why we do not include. Okay, because if you don't understand why, very simple. You see, let's say if you have already rented the factory and then the question tells you this one is the only project you can do for the coming 2 years. It's the only project you can do. If you do, you can earn 15,000 back. Okay, if you don't do, then nothing nothing at all. So now you need to ask yourself one question. If this were to be the only project you can do, should you do? You should do mindset. If you do, at least you use the factory and you can get back 15,000. But if you include this one in the calculation, then it will give you a negative NPV telling you you do not do, which is a wrong decision, because this one is committed already. You do, you need to pay. You don't do, you get nothing. You still need to pay. So get the point. So we only include incremental cash flows. Committed one, you just ignore that. All right. And the last one will be opportunity cash flow. This one I use back the same example from the lecturer class. It's something like you can think like you are working with this company A, you get 100,000 per annum. And suddenly some company B trying to headhunt you, offering you 95,000 per annum. Now you are considering this one. You are considering B. It's just like a company is considering an investment B. Let's say you are trying to calculate the NPV for B. All right, the net gain let's say the NPV without considering the opportunity cash flow is 95,000 after you deduct all the expenses you have a net gain of 95,000 if you work with company B. In this case, okay, should you include, because not currently you are working with company A earning 100,000, should you include this one in the calculation of B? Because now you are calculating NPV for B should you include this one? The answer is definitely yes. You must consider whatever you are earning right now. Because if you work for B, you cannot get A. The salary from A is that. So this is what we call opportunity cost. Which means the calculation, it should be 95,000 minus 100,000. Because any opportunity cash flows like opportunity cost, they are relevant cash flow. You must use this one, deduct this one, and or it's minus 5K, it's not a good investment, it's not a good choice, so I should stick back with A to get back my 100,000 now. You won't go to B1 because if you are not considering this one because maybe you think hey, why do I need to consider this one? If I calculate the NPV for B, it should be everything from B only Then if you give you a positive NPV, this one. If you give you a positive NPV, then you say yes, yes, I should do this one. Then wrong the decision. You get what I mean? So that's why opportunity cash flows you must include in your calculation. Also 1 minute for this slide. Make sure you are very good at the concept of relevant cash flows. Because I can tell you in the future why the NPV it can be so hard. Okay, it is because you do not know in Chinese we call it 前边万化. It means that it could be anything that test you. There are too many possibilities. Like a lot of time they will give you something very weird questions. Okay, it's actually referring to opportunity cost one. You need to understand that. If you don't understand this concept, suddenly you see, why the question now I'm considering project B, why the question give me another project one, telling me if I don't do, I have the cash flow is for what? If you don't understand, you don't include that, then your answer will be wrong. So make sure you understand all the concepts here for the relevant cash flows. 1 minute. Any question you can ask me. Nope, okay, very good. Okay, if you have no question, then this one also a quick one, but it's a very important thing. Okay, because again, in the future, you will see all these things. So I revise your first, okay, to give you some idea first, what are the things that you feel confused in the future, not only for this semester, for other like financial strategy and advanced financial management also. Another thing I have explained that before is the timing of cash flows. Usually this one is the timeline, okay, and we record all the cash flow, like year 0, you see when we write the table, year 0, year 1, year 2, year 3, you need to understand from year 0 to year 1, this is the first year, okay, this is the first year, while this one year 1 to year 2 is the second year. Very clear, because year 0 is the beginning of the project, or usually it's right now, to year 1 it means that it's the end of first year. Can understand? The problem is, in the future, you will see the question telling you something like, for example, you will receive 10 ringgit at the end of first year. So at the end of first year is mana. So at the end of first year is here. So when you record year 0, year 1, the cash flow, it should be 10, should be here. When you write the table, at the end of first year, very simple, this one. At the end of second year, then year 2. Sometimes you also will see that the question telling you, you will receive 10 ringgit at the beginning of second year. So at the beginning of second year is mana? Is here, It's also here at the same timing. Because at the end of first year is actually 31st of December. At the beginning of second year is 1st of January next year. So this one, when come to calculation, we consider that they are at the same timing. So if you see at the beginning of second year, then you should know. You should record at year 1 also. This one. You should assume that it happens at the end of year 1. Because it's closer. Impossible you record here. Why? Because here is at the end of year 2 already. If the question telling you at the beginning of year 2 or at the beginning of second year, then you should know it's here. Because I have seen a lot of students already, the question telling them at the beginning of year 2, they record here. Is it correct? Because they see year 2 only, year 2, I record here. Is it correct? Wrong. At the beginning of year 2, at the beginning of year 2 is literally it's just 1 year later, Actually, it's here, So that's why we should record at year 1, discount only one time. You record here is already 2 years already, the period. So be careful on all these little things. Now you might think that it's very simple, this one. But I can tell you, when it comes to a very long questions, if you are not sure, you confuse yourself at the beginning of year 2, at the end of year 1, what the hell is that? You ask yourself this kind of question. All right? And after that, okay, this one also very important. This one, you almost see that every time in the past year. Current selling price and the selling price for the first year, there are difference. If let's say the question is like that, current selling price is RM10, inflation rate is 10% per annum, which means I assume that we only sell 1 unit 1 year. Every year we sell 1 unit. 1 year sell 1 unit. If your question is like that, your year 1 is 11. Every year sell 1 unit. Okay, which means that your first year you sell 1 unit. And the 1 unit, the price we always assume that is based on at the end of the period 1, the selling price. So if the question is telling you current selling price is 10, current, it means that at year 0 it is 10. So 1 year later, due to the inflation, at year 1, at the end of year 1, it should be 11. And you sell 1 unit, and we assume that it's based on at the end of the period 1, the selling price. So when you record, it's 11. For the first scenario, you see this one, I give you 30 seconds. First scenario, if it is like that, you sell 1 unit, this is your cash flow. Year 0 the other, you don't put 10 here, because first year, again, 1 year you sell one time only. So 1 year, from year 0 to year 1, you only sell 1 unit. And we always assume that it happens at the end of the year 1. Selling price also at the end, follow the end of the year selling price. 11 times 1, so it's 11, we record here. All right, and if let's say I change the questions to selling price for the first year is 10, inflation rate is 10% per annum, then your year 1 it is 10, it is not 11, because this one is telling you, you see, selling price for the first year. It means that it's telling you from 1st of January until 31st of December, this whole first year the selling price is 10. So when you are referring to at the end of the year 1, the selling price is 10 times 1 unit you sell is 10. The price will increase next year. Every year increase 10%. So it's 1st of January next year until 31st of December, it will be 11. Know the difference? So that's why when we record for second scenario is 10, not 11. Don't go to times 1.1. Because it's already telling you for the whole first year is 10. Okay, so don't go to times 1.1. All right, and then the last part a little bit more, like what I said, a little bit longer, but this one is the last already. Okay, so the last part is real cash flow versus nominal cash flows. So first of all, in order for you to understand, I have an example here. If you deposit 100 into fixed deposit for 1 year, the interest is 4% per annum. Inflation rate is 2% per annum. All right. So what you need to do, what you need to understand is very simple. Nominal is something that we see in the real world, like 50 ringgit notes is a nominal cash flow, including the inflation inside one. Like if next year this item increases in price from 50 to 55, which means that next year you need to pay 55 to buy the item. That one we call that nominal cash flows. Just like example here, you see this example. Okay, I use red color to be clearer. Green color. This example, green color one, inside the box of green color. This is what we call nominal term. From this case, you deposit 100 ringgit today, 1 year later you get 104, right? You can withdraw from bank 1 year later 100 plus maybe 4 pieces of 1 ringgit notes, so 104 ringgits. This is nominal cash flows. All right, and the 4% that you are getting the return from the fixed deposit is nominal rate. So this one nominal rate, this one nominal cash flow. Okay, then what is real cash flow or real rate? Real term, it means that I am referring to the purchasing power, not the nominal notes that you receive or you pay. I'm referring to the purchasing power. What is the purchasing power? Is my purchasing power increasing? So this one exclude the inflation one. I'm looking only on the purchasing power. So this one will be the example. Okay, in here you need to understand this formula, Fisher formula. So 1 plus nominal rate equals to 1 plus real times 1 plus inflation rate. Okay, so from this formula you can see if I'm going to find the real rate, so the formula is 1 plus I divided by 1 plus H. Can understand this formula is from here. If I want to find the real rate, equals to 1 plus I divided by 1 plus H. So 1 plus I have 0.4. Nominal, I is nominal, see? So nominal is 4%, divided by H is 2%. And then this one, 1 plus 1 can throw another side, become minus. You will get 1.96%. This answer. Which means that the real return that you are getting is actually 1.96%. After you consider the inflation as a cost. This one is the real increment in your purchasing power. Or you can think like that. You invest FD, yes, you earn 4%. All right, you earn the money 4%. But at the same time, due to the inflation, the prices of goods and services will increase. The cost of the goods and services will increase 2%, you know. So that's why when you net it off, you just talk about your purchasing power. It increases actually only about 2%, 1.96%. Maybe you ask, hey, why not 2%? Why 1.96? Very simple. Because at the end, the inflation will apply to your final amount here, 104 is no longer 100. So that's why when you compute, it will be a little bit lower than 2%, 1.96% increment. Okay, or when you put in the, if you illustrate that by using the timeline, it will be like that. Year 0 minus 100, year 1 you get 101.96, and your return is 1.96. So everything here, they are in real terms. Real rate, real cash flow. Okay, 1 minute. Okay, I think I still have one more, but this one quick one, nothing one. This one is the last. Make sure you understand the nominal and real, the concept. Real term is the purchasing power. Nominal is the normal one. You can think like that. Nominal includes the inflation. Like if the selling price increasing, so you record that, increasing selling price due to inflation. But real term, we exclude all the inflation. Like in this case, we exclude that. We only want the remaining purchasing. We are referring to purchasing power only. Okay, okay, so now what you need to know, I put it simple. In the calculation, you just make sure that it is consistent. I have explained why need to be consistent in the lecture class. If you are interested, you can go to rewatch the lecture class. If you want to know why must be consistent, I have explained that. Even though you don't want to understand that, also doesn't matter. You just need to memorize one thing. Nominal cash flow must be discounted by nominal rate. It must be consistent one. Up and down must be consistent. Real cash flow must be discounted by real rates. It must be consistent. Because if you are not consistent, it will be like double counted. If you want to know in more details, go to watch the recorded lecture video. But now I have no time to explain all the things. Already 30 minutes. So just tell you all that if you don't understand, you memorize. If you see nominal cash flows, like nominal cash flow, it means that if you see the question telling you, or you see the price, you go to times the inflation one. The price you times follow the inflation every year increasing one. That one is nominal cash flow already. So when you discount it, you need to find the nominal rate. Okay, while real cash flow, if the question give you all in real terms, excluding inflation, make sure you discount it by real rate. Why do I need to revise this one? Because it could be, for an example, the question give you everything in nominal. The question tells you the selling price increasing due to inflation every year, show you the selling price. So the question give you nominal cash flows, but sometimes below the question could give you real rate. If you use the real rate as the discount rate directly, using nominal cash flow discounted by real rate, wrong. Okay, your answer. So usually in this case, the question definitely will give you also the inflation one. They will give you general inflation and the real rate. So you need to pandai. You look at the cash flow, nominal cash flow discounted by nominal rate. So now the question gives me real rate and inflation. So you need to times to get the nominal. Make sure it is consistent. That's what I want to tell you all. Same applies to after tax cash flows. Because you see our WACC, the discount rate, we always use after tax discount rate one, after tax WACC, like your after tax KD. So that's why the cash flow must be also after tax. Okay, the cash flow also is after tax. That's why you see our calculation is always minus the tax, include the capital allowance, all tax related one included in the calculation one. Why? Very simple, because our discount rate is after tax. So make sure your cash flow also after tax. It must be consistent one. All right, I think that's all for my part. Okay, 1 minute, any question? If not, then I think we can proceed to question 1 and 2 for your class. It's okay, small mistake only, never mind. Question 3 we discuss together. So if you have any question, please ask. Like, seriously, pay more attention when, especially in the tutorial class, when it comes to revision, try to understand that. I do not know your class, but first 2 classes, it seems like a little bit worried, okay, because some of the questions, I would expect that y'all can answer very well one, but it turned out to be not that well. So that's why if you have any question, please ask, okay? Don't feel shy to ask. But I also understand online classes is harder to concentrate. That one is an issue. Next semester, you all could, but next semester, you all go for industrial training already. Not able to concentrate. Yeah, it's harder for you all to concentrate. But next semester, there is a possibility. Now, faculty, because actually I think UC as a memo telling the faculty that we feel free. I mean the faculty can decide whether to allow you all to go back, study online or physical or hybrid. So you all wait for next year for y'all. That one not applicable for y'all. Too bad too bad. For y'all until next July. Wow. Okay. Very long in industrial training period. Okay, so too bad next semester can come back. You're also still going through your industrial training, but you still can go back to campus, use the facilities. You do not know. Okay, if you have time All right, I think the group can present right now. Question 1 and 2. Okay, just to let you all know we have 3 questions today. Question 1 easiest, question 2 harder, question 3 will be quite hard. Okay, I would say that if you all want to know, sir, the difficulty level of the final macam mana on this question, it lies between question 2 and 3 I would say. So you have the expectation later when we go through, then how difficult it will be. I would say that it's harder than question 3. It is harder than question 2, but it's easier than question 3. You will see later. Okay, you may continue your presentation. Thank you, Junming.
Okay, sir, can you hear me?
Yes, I can hear you.
Okay, so question 1, I will presenting the part 1 for question 1. The question is asking to find the net present value. So based on the question, we need to construct the MPV table out and to calculate the MPV lah. So look at the working one here, right? We need to, based on the selling price, we need to calculate out the sales by using the information from the question selling price, 30 ringgit per unit. And the question is saying that the selling price will be having an inflation of 2% for every year, starting from year 1 to year 4. So the 30 ringgit will be for the year 1 will be increased from 30 to 30.6 for the selling price, and the year 2 and year 2 to year 4 also the same increment of 2%. So then the selling price will be multiplied with the demand given from the question from year 1 to year 4. You get the sales amount. Then you need to fill in to this table, net present value table, and the now we're looking at the calculation working tool, which we need to calculate the operating cost. As the question saying that given that the variable operating cost is 10 ringgit per unit, and we need to include the inflation rate of 5% per year to calculate the operating cost per unit variable cost. So multiply with the demand as the question given, and you will find out these figures lah, these four figures for each of the years. And then you need to add with the fixed cost. Fixed cost also due to the inflation of 5% for each year, we have to times 1.05. We take this 200,000 ringgit times 0.15 for every year. So the total operating cost will get this figure, and we plug in to the net present value tables. And for these two already done, then we, as the question saying that the investment cost will be 4 million, so we need to put it at the year 0 before the project begins, and then we can find out the net cash flow by adding up the sales, operating costs, and investment costs. And then we need to take into the consideration of the discount factor. As the question given that the nominal discount rate is 10%, then we need to include the 10% of discount factor, and finally we will get the total of present value for each year, and the net present value will be 389.2 thousand ringgit. So I think that's it from me. Now I will pass it on to the next presenter.
Hold on, Jiming. Before we proceed, okay, we look at the MPV first. Back to here. Okay, and your answer are very good, very clear. Okay, can see the question and the answer. I should have learned you all doing something like that. Okay, okay. So, all right. So this one is like what I said, is a very simple question. But from this question, you also need to be careful on few things, okay. Like what I said, first thing when you are calculating MPV, make sure everything's there. If you read the things, okay, can you see any profit there? Okay, it seems like it's not profit, you times the selling price with the units is supposed to be cash flow. So this one no problem, because you want to calculate MPV at the very beginning. So I think will be cash, everything will be cash there, no problem. And if you look at the selling price, all right, the selling price, current price term, when you see that, like what I said, you should understand that it is telling you selling price at year 0 right now is 30. And if the inflation is 2% per year, then when you record, like you see your year 1 there, it becomes 30.6, which is correct, because year 0 is 30, current selling price. So year 1, inflation for that 1 year, if you increase to 30.6, like what I said, you need to be very keen on all these words, current price term. If I change the bracket for the first year, then your year 1 is 30, no need to times already. You all get what I mean? If you don't get what I mean, please, okay, raise a hand or what, respond to me, I will explain again. There is a difference between current price term and for the first year. If current price term, it means at year 0, So when you record at year 1, you see that year 1 is already 30.6, which is correct. If the question is telling you selling price bracket for the first year, 30. So until the end of year 1, it is still 30. You do not times 1.02. Okay, so this one be careful. And you see the last sentence, because I want to train you all to be very keen on all these words. CG uses a nominal discount rate. Remember this one? Nominal is what? Nominal is the normal one. So you make sure that all the cash flows you have calculated are then nominal cash flows. So from this question, I think no problem. They are nominal cash flow because you see, you consider all the inflation, include the inflation, and then the selling price keep on increasing one. So there are nominal cash flows. Discounted by nominal rate, is it correct? Correct, no problem. Why I want to tell you all that? Because in the exam, I could give you like this question. Maybe I will add another. The nominal discount rate is 10%, while the real discount rate is 5%. And you all need to select which one will you use for the discount rate. You get what I mean? Then you should know, this one I times everything with inflation one. So I'm using nominal cash flow. So discounted should be nominal rate also. You get what I mean? The potential tricky parts that you face in the final or in the future. All right, and then other than that, I think okay, nothing special for this question. You may continue. Thank you for IRR.
Then so I will be presenting IRR. So the IRR formula is A plus NPV A divided by NPV A minus NPV B, then times with B minus A, which is the A is lower of the rate and the B is the higher rate. Then so from the question and from the first part, we already calculate the NPV for 10% nominal discount rate. So for the IR part, use the another discount factor rate, which is from the discount factor table. Then from this question, it takes 15%. So by using the net cash flow also from the first NPV calculation there, the table can get from there. And then multiply with the discount factor 15%, then we can get the net present value for 15% discount factor. Uh, then the NPV for this discount factor will be negative. Then the IRR, we bring in the amount into the formula. So A is the higher rate, so it's the 10% plus the NPV A, which is 389.2, and divide by NPV A plus NPV A minus NPV B. But the NPV B is negative, so negative negative you can get a positive, so it's 389.2 plus 52.3. Then multiply with and the higher rate minus the lower rate, so it's multiply with 5%, then we can get a final answer for 14.4%.
Okay, very good. Okay, everything you explained seems to be correct, but my question will be on you, Xiang Yuan. Okay, because I think all of you know, you have done IRR before. You must have two discount rates. Okay, two discount rates. One give you positive NPV, one give you negative NPV. Must be one poor, one there. You cannot two positive or two negative. Cannot. Must be two discount rates. One lead to positive NPV, one lead to negative NPV. And usually these kind of questions, when you are calculating NPV, can you show me the answer of A again? Sorry, A1, above the answer. Yep. Okay, right. So usually when we are calculating NPV, definitely we have one discount rate and the NPV value already. Like this one, I think we are using 10%. From the question, nominal discount rate 10%, we get the NPV is positive NPV. And if you were to calculate IRR in the final, the another rate, if you not be given one, you need to estimate yourself what is the percentage to be used. Okay, Xiang Yuan, why do you know you need to use 15% for another rate? Any idea?
Because the discount factor from my knowledge is because the discount factor start from year one is lower if we choose the higher discount factor. So the MPV will be lower.
Not necessary. Sometimes you need to deduct the discount rate in order to get another sign. All right. So anyone can answer me on these questions. So my question is your MPV just now when you are calculating your MPV, you use 10% discount rate, then your MPV is positive So now you are going to find the negative MPV. Okay, because you want 1 there you have the pole already, 10% give you positive. Then now you want the MPV to be negative. So what rate should you use? In the exam, how should you find the figures out? Inflation, nothing to do with inflation. Good try, okay? Nothing to do with inflation.
Plus or minus 10%?
Yeah, you can plus or minus 10%, no problem. But in this case, how do you know when should you plus, when should you minus? My question is like that. When should you plus, when should you minus? Because if you use a wrong sign, you wasted your effort. If you use a wrong sign like this case, this case is actually plus, right? You use 10% and then you use 15%, you plus another 5%. In the exam, if you do not know, if you minus 5%, it gives you 2 positive MPV, then you cannot apply. Okay, Johari saying that lower than the IRR, but now you also do not know the IRR. You also do not know the IRR right now.
So
you want to calculate Yes.
Is it the higher discount factor will giving you the will discount more of the present value? So
Very good. Yeah. Junming, you got the point. Okay, that's the answer I'm looking for. All right. I think Ivy also saying that keep trying different percentage. Can if you have time in your exam then you keep trying but it's not the correct way What Junming said is very, very true. Okay, how to decide? Actually, very simple. You must ask yourself one thing. The discount rate is referring to what? What is the discount rate in this case? The discount rate is your WACC. So what is WACC? It's the cost of your capital. Correct? What we have learned previously. And for a midterm, the WACC is the discount rate, So which means that if you are using 10%, it means that when your cost is 10%, the cost of your capital is 10%, you get a positive MPV. It means that the value of the investment is positive. So now what you want is, I want the MPV to be negative. So you just ask yourself one question. If I want to reduce the value of my investment until it becomes negative, because now it's positive, I want it to become negative. The value of the investment, MPV, I want negative. So what should you do with the cost? You increase the cost. So you can increase, like what Zihong asking, can we use 20? Can, no problem. Okay, can, no problem. You use, in this case, I think 5%, 10%, and as long as you can get another figure is negative, then we'll be all right. So when you increase, my personal recommendation, plus minus 5%, or you use plus minus 10% also can. Which means that when you increase, you don't be so stingy. Like if in this case, if you know that, I increase the cost, so 10% I get positive. Now I increase to 11%. You try to calculate, maybe also positive MPV. You waste your time. Because yes, you increase the cost, but the increment in cost still not enough to make the MPV to become negative. So you waste your effort. Trust me, in the exam, remember, you plus or minus 5% or 10% also can, up to you. Like Zihong said, 10% cost I get positive. I want to try 20%, can or cannot? Can. I guarantee you, like if you change everything, the 15% to 20%, for sure you get an even more, a larger number of negative figures. You still can apply the formula, no problem. So this one is on you, because like what I said, another rate you do not know. So you just remember one thing, discount rate is a cost. So if let's say like this case, 10% cost, my MPV positive. Now I want to bring down the value until negative. So the cost should increase. I should increase the cost to make the MPV to be lower until it becomes negative. Wow, not always like that one, because in the exam, it could be you calculate the MPV, by using 10% lah, then the NPV is negative 300,000. So what should you do? You increase again. Cost 10% is already minus 300,000. You try to use 15%. Higher cost the NPV even lower, maybe minus 500,000. You cannot apply the formula, must be 1 for 1 net. So if you see 10% negative 300,000, the next step you should use will be you need to use lower cost, maybe 5% or even 1% to calculate, because when your cost is lower, then maybe your NPV definitely will increase until it becomes positive. So you get 1 for 1 there. That's how you find another side. Not keep trying the percentage. We keep trying also can. But not easy one, you know. This one, if you want to recalculate, you see the formula. When you read, it's not very hard also, but it takes you time. Like, okay, no problem. I said, I keep trying. I try 115, try 15, must be, I will be able to get another sign. Can, but you have wasted some time. Okay, so use the correct way. The direction is very easy to get on which direction you are going. Just remember the DF, the discount rate is a cost. If you have positive, you want it to become negative, increase the cost. If it is already negative, you want to increase the value until positive, then decrease the cost. That's the correct way. All right, you may continue. Thank you. I think calculation, no worry, you all have done that. Okay, for the third one.
For the part 3, question asks to calculate the ROCE with the accounting rate. So we use the formula about average annual profit before interest and tax divided by the average investment. So to calculate the average annual profit, we use the total cash flow. We can take from the IRR rate, the above, and we sum up, then we get the 5,559.5 cents, 8.9 cents, and then we minus the accounting cost, which is investment cost 4 million and the scrap value divided by 2. So yeah, minus this, then we get the 1,759.9 cents. Then we divide by 4 years, and we get the annual profit, which is 440 ringgit. And then we divided by the average investment, which is the investment cost and the scrap value, divided by 2 and times 100%, and we get the 21%.
Okay, is correct, but this one again, one thing you need to be careful, especially when you look into these kind of questions. You see, like what I tell you just now at the very beginning. When you look at the question NPV, IRR, suddenly ROCE, that in your mind it should be first thing. NPV, IRR, they are based on cash flow. Okay, so the above they are all cash flow, no problem. But when it comes to ROCE, it is based on profit, you know. But what you get from the above, it seems like everything they are cash flow. So like what I said, don't panic, no need to worry. Remember the golden thumb rule. If you want to have profit, but given is cash flow, what you need to do very simple. You just need to use the cash flow, deduct all the depreciation. Then you get a profit because profit should be after the depreciation. So that's why you can see the total cash flow here. We are getting all the operating cash inflow from the selling of the goods, including the cost from their contribution. Okay, and then you see total accounting profit. What should we do? Because cash flow is we do not deduct depreciation to get the 5559. We do not deduct depreciation. But if we want profit, we need to deduct the depreciation. So that's why you can see the 5559.9 we minus 4 million minus 200,000. That one is depreciation of the asset. Because you purchase the asset at the beginning 4 million, at the end you sell for 200,000. So for the 4 years, total depreciation is 3.8 million. So now you all understand why do we deduct that 3.8? Because we want the profit, so we deduct the depreciation to get the profit. All right, once we get a profit, then will be very simple because the ARR is just average profit. So divided by 4 years, we get the annual profit divided by the average investment value. Is using the 4,000 plus 200 divided by 2 in order to get the answer. Okay, I think that's all for question 1. Thank you very much for your presentation. Then we can proceed to question 2. Again, our level will be getting higher and higher, question by question.
Okay. So for question 2, part A is calculate the NPV of buying the new machines and advise on the acceptability of the proposed purchase. So we need to find out the WACC first. The VEVD, KE and KD is given in the questions, which is the bottom parts, so that we can calculate out its WACC is 10% based on the formula given. So to calculate the NPVs, there is 2 workings needed, which to find out the contributions and the CA CA tax benefits. Okay. So for the working on contributions, we base the additional demands. We can find in here the forecast demand, but here is given at 1.4 million, but we only use 0.4 million because it is only limited to 1 million kilogram per year. So all of these have to minus 1 million. Just use the additional. Okay, then followed by is the output of new machines. So for the 3rd year and 4th year, it will be the same. And contributions per kg is using this 8 ringgit per kilogram minus the 5 per kilogram and minus the variable cost of 1.9 per kilogram. Okay, so it's found out 1.1 for everyone. So we just multiply it using the output of new machines, multiply 1.1. Same goes with other years. So to find out the capital allowance, the cost given is given, which is this is bought at 800,000, and then each year it's need to minus 25%. We mentions in the questions on the claim capital allowance on 25% reducing balance basis. Okay, so we use the 2nd year is 800,000 multiplied 75%, and 3rd year is same. So for the capital allowance is 25%. Then the WDV is just use the cost minus the capital allowance. And the tax is based on the capital allowance multiply 30%. Then you can find the 3 years tax. So for the year 4, we use the previous year tax 33,750 minus 30,000, and we find the BA. Yeah. Then the year claim is next year for every year claim claim for capital allowance. So we go back to the ways of calculations NPV. We just put in all the first working answer and second working. So we use the contributions minus the fixed cost. Then we can find the net cash flow. And the taxations is based on the tax we calculate just now. 30%. So it's minus 60, minus 87, minus 114, and 108. After that is the answer for the capital allowance tax benefits. And we put in the scrap value also, and after tax cash flow. Okay. Yeah. Then after that, we use the discount factor of 10%. We can find the present value given. Then lastly, we use the invest plus investment. The PV of benefits is the investment minus the NPV, and which is 78,000. Yeah, that's all.
Okay, basically you explain most of the things other than I think one part is not very clear, which will be on the can you show me the working one? Working one, yes. Okay, I want to ask you on these questions. Okay, can you drag the picture? I think it's a picture. Is that? Can you drag down the question? Yeah, yeah. Okay, very good. Okay, drag down. Okay, perfect. Okay, good. Okay, so as you can see from these questions, all of you can see the year demand KG. Can you see year 1 is forecast demand is 1.4, year 2 1.5, and so on. And if you read this question, actually this question is talking about we are considering should we buy one more machine or not. Okay, that's what we are considering. This one is a project on should we buy one more machine. All right, and if you read you can see that after the demand there, existing production capital for this company is limited to 1 million kilograms. You can see the bolded word, which means existingly, before you buy the machine, before you buy the new machine, existingly using your old machine, okay, whatever machine you are having, you already can produce 1 million kilograms every year. Okay, you have the existing capacity to do that. If you purchase the new machine, then I think from the third sentence you can see a maximum output of 600,000. Can you see the third sentence? Yeah, this one of this company per year, which means that if you buy one additional machine, the additional machine can give you additional 600,000 outputs, produce additional 600,000 outputs. Okay, and from there, Zihong, can you tell me why do you see your year 1, why do you only record 400,000, not 1.4 million? Any idea on that?
Is for the output of new machine or the additional demand?
Very good. So this one is based on what concept? Why don't you include 1.4? Only 400,000. Why only additional?
Because it's already start. I think this one is counted for like buying the new machine. So actual like from the beginning the company can already produce 1 million kilogram per year.
Yep. So the
additional is just like all these need to minus 1 million, so it's just 0.4 million, which is
very good.
100,000.
Okay, so actually this one, if you remember just now in the revisions, why do we do that? It is because we record only incremental cash flows. If you remember what I said just at the very beginning, same like what Zihong explained, is because now we are only considering the new machine. Existingly, we can produce 1 million already, which means that even I don't buy this machine, I continue, I also can have every year 1 million. If I buy the machine that is like, the additional one will be the additional benefits brought by this new machine. So we only include the incremental cash flows, if you remember, which in this one will be 400,000, 500,000, 600,000. But one more thing, why the last year only 600,000, not 700,000?
Because maximum output is 600.
Very good. Okay, so that's the reason why this kind of question, it can be very hard sometimes. You see a lot of tricky things, a lot of things you need to be careful. If you overlook that, you'll be wrong. If you record 700,000, they're also wrong, because forecast demand is telling you forecast that 4 years later, the demand from your customer will be 1.7 million. But you need to ask yourself, Existingly, you can produce 1 million, plus the new machine, you only can produce maximum 1.6. So even though your demand is 1.7, I can tell you 4 years later, you can only produce additional 600,000 from the new machine. You cannot achieve 1.71, maximum 1.6 only. That's why we record only 600,000. All right, very good. So all these will be some things that you need to be careful. And for the capital allowance, this one I also need to explain something. This one. So for the capital allowance, all of you look at the calculation. I think I give you 1 minute first. You look at the calculation, see whether you all can understand or not the calculation. We will record only the tax savings. You can see the tax at 30 there, isn't it? 60,000, 45,000. We will record only that in the calculation. That's the tax savings from your capital allowance. You don't really need to understand, but I think all of you know how to calculate. This one I think is reducing balance. Your written down value at the beginning, you purchase the asset at 800,000, and then at the end you sell for, I think, at the end you sell for berapa? At the end you sell for 30,000. And then from there you calculate every year the written down value and the depreciation, and from depreciation there you calculate the tax savings. Okay, the 60,000, that column, the last two columns is actually the tax savings that we will record later. Yeah, this one. So all of you, the others, have a look first. Make sure you know how to calculate. 1 minute. Then I will proceed with the explanation. So capital allowance, 25% reducing balance. I think accounting student, you all should know how to calculate actually. I think 100,000, 200,000 depreciation. Next year, written down value 600,000, and another 25,000. 25% depreciation. Written down value 450,000, and from all the capital allowance, then 30% will be your tax, so times 30%, that one will be your tax savings. Just understand the calculation first. The last year you need to be careful. The last year will be the written down value at the end, and then minus the scrap value, because only 4 years. Minus the scrap value, which means that the last year, the balance will be the total depreciation already for the last year. The 307,500. If you have any question, you can ask me. If you have no question, because I believe that, you look at that, you should know how to calculate reducing balance. You have done that many times, I think. I don't think I need to explain how to calculate. But what I want to say right now is, in a normal circumstance, like in the lecture class, I don't want to explain too much, but in a normal circumstance, all the tax savings, the 60,000, 45,000, and so on, that one, usually you start to record that at year 2. Usually at year 2. Reason is because we always assume you purchase the asset at the beginning of the project. At year 0, we purchase the project at the beginning of the project. Correct? Okay, we purchase the asset, something like fixed asset like this machine. All right. So at the end of first year, then we will compile our accounting figures, everything. What will be the tax we need to pay, and then from there we can claim how much as our tax relief. Correct? It's at the end of year 1. But when in cash basis, I can tell you, usually you cannot be the last day immediately you compile everything, then you know how much tax you need to pay, then you pay immediately. And the tax savings you can claim immediately. You cannot one. So that's the reason why you see all those tax payment in cash usually also delay. We pay in next year one. As you can see later, the answer that we show you. That's why the tax we also pay 1 year in area, like mentioned in the question. Same applies to the capital allowance. When we claim actually is year 1, the tax savings, year 1. But at the time we offset the tax payment is already next year. So it's always year 2 onward, 2, 3, 4, 5. Okay, unless, listen carefully, unless one thing, okay, the question telling you the asset you purchase is 1 day before you start the project. So it's before year 0 you purchase. So you compile your tax there, year 1, then you can claim. If not, if you don't see anything like telling you, or actually two possibilities, it's either like what I said. First one is, unless the question telling you purchase the asset 1 day before the project starts, you see something like that 1 day before year 0, then you claim at year 1. You can refer to the lecture note. Or another possibilities is they are telling you your tax savings you can claim immediately at year 1. Or sometimes the question will tell you that your tax savings you can claim immediately. Year 1 you can claim, no need to wait for year 2. Then you record started from year 1. If not any other circumstances, we always assume you purchase the asset year 1, you compile, and then you claim year 2. Always like that. All right, so it's 2, 3, 4, 5. Okay, I remember that. Okay, you all may continue. I think nothing to continue already, is that? What else? Hold on. Let me read. The NPV first. Okay, let me see. Is there anything you all need to mention? Okay, taxation 1 year in area. Okay, no problem. Other than that, I think just now already explained quite well. After tax cash flow. Okay, discount factor, this one sometimes this one is also another thing. Sometimes it's not given directly. You can see this question, you cannot find the discount factor, you cannot find the cost of capital. Why? Because you need to calculate yourself. That's why you can see from the calculation, but this one is very simple. I think all of you have gone through the midterm. You all should know how to calculate. This one is the easiest one. KE, KD given directly, and they give you the capital structure. Then you have the 10%, then you apply 10%. Okay, other than that, I think should be okay. And you see the investment just now, the investment. This one is up to your investment 800,000. Up to your. You can put at year 0 also. I do not know why former answer that like to put that another side. Okay, also can or you can just put year 0 minus 800,000 in your answer also can, no problem. It will give you the same answer. Right, I think that's all for this one. You all may continue. Thank you.
So hello, so I'll be presenting the part B, internal rate of return, IRR. So to get the negative NPV, we need to calculate the NPV, the discount factor again. So we use 15%. Like Sir said just now, we plus the 5% because we need to find the negative NPV. So using the value in the part A, the after tax cash flow, we put the discount factor at 15%, then you get the present value. You total up the present value, you get 784,000, then you minus the investment, which is 800,000, then you get a negative NPV. So you substitute inside the formula of IRR. You can see that A is 10%, B is 15%, the NPV positive is 78, and then the negative is negative 16. Then you substitute all inside, and you get 14.2%.
Okay, everything is correct there. Thank you, Lian. So actually, there are some theories that they're also asking you the acceptability of the proposed purchase. Okay, here also remember one thing. If let's say the question asks you to discuss the, like for example, just like NPV also got, I think, can you scroll up a bit? Yeah, this one is for the NPV one. So you calculate the NPV is positive just now. And then sometimes the question will ask you, discuss the answer calculated in part A1, something like that, from your NPV. So you can see this one, explains so much one positive NPV. It depends on the marks allocated. I can tell you, if the marks given is only 2 marks, 2 marks, you just say NPV positive, accept the project because it maximizes the shareholders' wealth, full stop, you get the 2 marks. Get what I mean? If you see the question asks you to discuss the answer you get from part A1, something like that, ask you to discuss, and the marks given is only 2 marks, then you just explain. We would accept the project because it has a positive NPV. Full stop, that's all. All right. But if you look at the question, marks allocated is like 7 marks. Can you just write positive NPV is good? Accept the project? Definitely not enough. So if you have a 7 marks or 8 marks question ask you to discuss the answer above, you need to explain some things. All right, like in this case, it explains. This one is up to you. How do you explain the additional things? You can talk about the weaknesses, you can talk about the recommendations. It's basically just asking you the answer you get from the NPV. Is it reliable? Something like that. You can discuss, right? So like this one is telling you that the former answer is telling you that it seems to be acceptable because positive NPV. However, the first paragraph actually is telling you the suggestions. However, the former answer saying that maybe we can also consider to buy an even better machine, because here actually it explains you can see the fourth year our demand is 1.7 million, but if we buy this new machine it can only support 600,000. We can earn 700,000 one 4 years later, but because of this machine maximum output is only 600,000. So there's limitation there, so might not be the best choice, and this machine we can only use for 4 years, seems to be too short. So actually the answer here is recommending maybe we can consider to buy an even better machine, can support a higher maximum outputs one and can use for longer period, then it could give us a even higher positive NPV. You can say so, no problem, up to you. And the second also saying that we should also be careful. This one, it would be advisable to look in more detail on another issues. For example, from the question, we assume constant selling price and constant variable cost. That's why just now we do not times any inflation or this thing. So here you can mention, hey, have we considered inflation already? In this case, we just assume that over the, coming 4 years, all the selling price, all the costs remain the same. It seems like a little bit unrealistic. So maybe it's another area that we should consider to improve. All right, so all of these can actually, like what I said, it's not a fixed answer, it's up to you. But just remember that if you look at the question, ask you to discuss 7 marks, you don't just give me positive NPV, accept the project, full stop. I will only give you 2 marks. Ask you to discuss the answer, so you should expand more. So this answer, is it reliable? What will be the thing that we overlook? You can include in the answer. All right. And the acceptability of the IRR, the below one. Below we have another just now. Yeah. Okay, so for the IRR, actually very simple, because IRR it's something like NPV also. As long as your IRR is higher than your cost of capital, then you can accept the project. As simple as that. All right. Why? Because again, your cost of capital is 10%. Okay. IRR is 14.2%. So you ask yourself, at 14.2%, if your cost were to be 14.2%, your NPV 0, no gain, no loss. But now the cost of your company is only 10%. Correct? So which means that the cost of capital of your company is lower than IRR. Which means 14.2% NPV 0. If your cost at 14.2, but now your cost only 10% is lower than IRR. So your NPV definitely positive one. So you can accept this project. But again, if the marks given is like 7 marks, then you expand more the problems of IRR, the cash flow estimated might not be accurate. All these things you can expand. All right, I think that's all for question 2. Thank you for your presentation. Okay, now I will show you the question 3, which is the most complicated one. So I will give you 2 minutes just to quickly read through the question, because it's a really tough one. This one no longer needed. Like what I said just now, if you remember, your final, if you ask me difficulty level, between 2 to 3, tougher than 2, easier than 3. 3 is really hard. I cannot show you 1.5 pages. Very long question. So maybe I give you some time. You just spend a little bit time to quickly go through this question. Just a quick one. Later I will expand for y'all, no worry. But I want y'all to experience the difficulty level. And I can tell you the difficulty level for your financial strategy. advanced financial management, when you see NPV question again, trust me, it will be something like that. Trust me, it will be something like that. The difficulty level. That's why I said NPV, it can be very difficult one actually. This is what we call you need to have all the knowledge okay, on how to do all these things.
Boy, come exciting, boy. What?
Okay, can experience the difficulty level of these kind of questions. Very, very long question. And I believe if I come out this kind of question in the final, I think most of you will not be able to answer because it's really very complicated. But it's good. I just want you all to have to experience that how difficult it could be for this kind of NPV question. Okay, so don't worry, this one I will explain for all of you. Okay. Okay, so I explain the case for your first. So this case probably basically is talking about now is today, and year 0 is not really today. Okay, year 0 is the beginning of the project, is 1 year later. If you read the question, they will tell you on whether you sign agreement to proceed with this new investment. Is a new technology, I think, to develop a new technology. If you want to do that, you sign the agreement, will be 1 year later. And that one is the start of your project, year 0. So your year 0 is not today in this case. Why need to be 1 year later is because the question telling you, because you need to conduct a feasibility study. For your knowledge, feasibility study is basically you need to study on whether or not you are able to carry out or implement this project, which actually is more practical or more realistic, because you see sometimes it's not saying that NPV, the project NPV is positive that you can invest immediately on. You need to also find out that whether you have the resources, you have the talents to implement the project. Is it feasible or not? Feasible means that is it workable or not? Can you do that? All right. So the question saying that the company will spend has already decided. So this one we will do right now. Before even we decide we want to continue this project or not, we must have the feasibility study first. So we will conduct feasibility study for 1 year. From the question, if you read, it tells you that we will hire a consultant, and then the feasibility study fees is 1 million. We will spend the money first. And then next year, or what we call at the beginning of the project, okay, year 0, then if the result is yes, it is feasible, let's say. If it is feasible, then we will calculate the NPV lor. If the NPV is positive, then we will continue lor. So at the beginning of the project, the year 0 is next year, is here. You will decide whether or not to sign the agreement 1 year later, after the feasibility study. And this one is officially the beginning of your investment from the question. Okay, not yet finished. And from the question, if you read, and it's telling you that your operating cash inflow not so fast, because the question saying that even though after you have decided, yes, we will proceed, we will undertake this project, we sign agreement, then we need to build a new plant. Usually the question, we will just assume that you buy a new plant at year 0 and immediately you can use that. But realistically, I think you all know it's not that all the plant can be usable one for the new project or for the new technology. So this case saying that we need to spend 1 year time just to build the new plant, and then we call that setup period for 1 year. Okay, so 1 year later you have all the fixed assets, team, okay, completed, then we can start to operate for 10 years. So this project will run for 10 years operationally for 10 years. So which means that will be from year 2 to year 11. 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 10 years. 2 to 11, not 9 years, 10 years. Okay, so this is the case of this question. All right, the timeline. Okay, so right now, like what I said, from there, we are going to find all the relevant cash flows from the question. Okay, we talk about year 0 first. Yeah, so from the year 0, you see the license fees, you see the project manager fees. Okay, all of these will be from here. Yeah, I can show you the answer with the question or not. This will make it smaller. Okay, I hope that you can see that, even though it's pretty small. All right, so from here, first thing you see this one, if you read this one is between here, today, okay, is today until year 0. Actually, you do have some cost one, 1 million and 2 million. You hire one consultant, cost you 2 million, and then the assessment fees. But you read, if you read, a preliminary non-refundable assessment fees of 1 million is payable. Okay, so which means actually you will not see this 1 million and 2 million in the calculation. So maybe you will ask, hey, why this one is not included one? Because now is today, why today is not year 0? Year 0 will be 1 year later. Because you need to understand, here we have 2 decision-making process, and this one feasibility study, regardless in the future you do or don't do, do you need to conduct this feasibility study? The answer is for sure you need to conduct. You don't talk about year 1 later, you decide again whether you want to do or don't want to do. Either the NPV is positive or negative. Now the first thing you need to do is conduct the feasibility study first. All right, to test that is it feasible. So which means that actually the costs, even though they are future costs, you haven't paid for that, is that it's not sunk, but you think about today, this one is already committed. You must conduct already this feasibility study. You must conduct first. So it's kind of like committed cost from today to year 1. That's why it's not included in here. And the question also say, because, or you want to think it easily, will be the question same. Actually, the project start at when you are signing the agreement. So it start at here. So you also can think that if you think about here, then the whatever happened, that one definitely you spend already one for the 3 million. So there are the sunk costs already. When you come to a decision on whether you should continue with this project, that one whatever spent is already sunk cost, nothing to do. Okay, so we only consider future. So in the future, year 1, we have the setup period, which including the license fees. License fees is here. Okay, you see, during the setup period, the licensor will have to be appointed as a project manager as a fee of 2 million. This one is project manager, 2 million. And the 20 million one will be here. A license fees of 20 million is required upon signing the license agreement. So that's why you must understand all this timing, like what I said, is very confusing one. But if you understand the case, you know, signing of license agreement is at year 0, you sign. So we record at year 0, 20 million. And this one is the fees 2 million for the project manager. Equipment cost 20 million, pay 2 times. This one we follow this one only. Or in real terms, it means no inflation one, this one. This one we follow. You also need to look at that. All of these, they are cash flow, but they might not be relevant. So is equipment cost relevant? It's relevant not, because if you want to do, you only pay one, this one. So if here is feasible, you want to do, NPV positive, you want to do, then you only pay. So this one is a relevant one. It's incremental and future cash flow also. Okay, so we include that in the calculation. And year 1, another 20 million and 10 million contractor fees. If you look at that, definitely relevant because this one again incremental one. If you do, then you only pay. One-time hire of special machine also relevant. Test run and training also relevant at year 1. And investment in working capital also relevant. So we just include, just copy paste only from here. Everything relevant, this one. Nothing wrong. Alright. And then from year 2 to year 11. Okay, why year 2 to year 11? Because after that will be the operational wise. Every year will happen this one every year. So you need to ask yourself again, sales revenue, is it relevant? Definitely relevant. If you do, you only receive this one, 80 million. Variable cost also relevant. Additional fixed cost, okay. Additional fixed cost relevant because it's incremental. It's telling you additional, it means that if you do, then you pay additional fixed cost per annum. 4 million also relevant. And we have one more thing here. The 8 million is actually from the loyalty percentage, I think. Where is that already? Here. Because here also saying that the annual loyalty payment of 10% on sales revenue is payable annually at the end of each financial year. So this one also relevant. Because if you do, you receive the 80 million, then you need to pay 10% as a loyalty fees. So all of these are relevant. But you will notice one thing from this question. This one is not relevant. Allocated head office overhead per annum is not relevant. You will not see, this one is a cost, but we do not deduct from here, What's the reason? Okay, the reason is because if you remember in the lecture notes, all those like overheads, okay, they are committed costs, like electricity bills, normal one, okay, normal use one, especially at your head office one, HQ one. They are committed costs. You do this project, don't do this project, your office no need to open. You still open one, you still use all the electricities one, like the aircon still need to be on, whether or not you do this project. Alright? So which means that as long as in the exam you see overheads, in your mind you should know that it's committed cost. No need to include one. All these overheads. Because this one happens arbitrarily. Naturally it happens. If you do, even you don't do this project, office still need to open one. You still need to pay for some cost. So they are committed costs. So that's why this 1 million is not in here. That's the reason why. Alright, and then you have the tax savings on capital allowance. This one strict line basis. I don't think I need to explain that. Very simple calculation. From here, actually it's already here. Strict line basis. You can claim backlog every year. And this one I think is within the same year it states. This one, because here, this one is just now like what I said. it tells you directly you can enjoy the tax savings year 2 to year 11. So we just follow year 2 to year 11. Timing already given directly by the question. All right. And all of this, and we have the net cash flow, and this one will be the cash flow that happens every year from year 2 to year 11. Every year, year 2 to 11. Every year, 22 million. Okay, and then year 11, we have one more thing, is the working capital will be released. If you remember what I said in the lecture class, working capital usually at the end it will be released, because working capital at the beginning you purchase like raw material, your inventory. At the end of the project, you sell all your inventories back, and whatever receivable you're having, you collect them back. So you have a cash inflow, same amount. This one will record here, not here, because this one is not happening every year. It happens only at the end one time only, while in here one will be every year. Okay, and then we will get the net cash flow. Then we come to the discount factor. Here, remember, this one, all of you, please listen. If not, when you are doing revision, you cannot get this figure one. I'm afraid some of you might not be able to get this figure. Okay, when we come to discounting process, this one year 0 we times 1, no problem. Year 1, because it's the real cash flow, you see, everything here is real. So we are going to find the real WACC. From the question, we have the real cost of equity, we have the real KD, and we have the capital structure. So we know that the real WACC is 10%. So real discounted by real, okay, real cash flow discounted by real rate. This one no problem. But the problem is, how do we get this figure? 5.586. This one is the annuity for the cash flow from year 2 to year 11. Not year 1 to year 11, because year 1 is the setting up period. So operationally, this cash flow happens from year 2. 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. 10 years annuity. But how do you get this figure? You all try to find out the answer. Discount table. Table A4. You can find the figure from here, but macam mana? Too small. I think you all go to refer to your own discount table. I will give you a few minutes, because I don't want that when you're doing your revision, when you come to this figure, you do not know how to get this figure. Try to think about it, how to get this figure. The annuity discount factor from year 2 to year 11, how to get this one? 5.586. Any idea how to get this 5.586? Very good. Okay, Xiang Yuan. Okay, I think you got the answer correctly. All right. So all of you, remember, because like what I said, if not later when you are doing revision, you do not know how to get this figure. Actually, very simple. Because now what we want is from year 2 to 11, right? So we can just use 10 years is this one. Okay. 6.4951. But this one is from year 1 to year 11, right? From year 1 to year 11, 11 years annuity. We don't want that. We only want year 2 to year 11. So what we need to do, very simple, we can just use this figure minus out the first year, because we don't want this one. The discount factor for first year we don't want. So if you use 6.4951 minus 0.9091, then you will be able to get this figure, 5.586. All right? Or if you all forget already, when you are doing revision, you find Xiang Yuan. Okay, Xiang Yuan will be able to answer for you. Remember this figure. Other than that, the normal this one all table A3, because this one other columns one happens only one time. It's just that this 2 to 11, it happens every year. Of course, another way, if you don't want to use this one, you also can draw many column 1. 2, 3, 4, 5, 6, 7, 8, 9, 10. If you want to draw, also can. Okay, but wasting time. So we use annuity. Just that the annuity, you be careful, is from year 2 to 11. Okay, then we add everything up, we will have the net presence value. Okay. Then B just asking you discuss. Okay, so we just say that it's positive, then we accept. All right. And C, even though this investment is financially okay, same thing. We look at the question first. Quick one. Okay, the question. Okay, this is like what I said. If in the exam you see something like that, explain the result in A above. Okay, it's a positive MPV. So you explain, if you see only 1 mark, don't think too much. If positive MPV, you just say, accept the project because it has a positive MPV, full stop. I guarantee you get a full mark, 1 mark. Only 1 mark. Don't expand any other grandmother story, because only 1 or 2 marks. You just say, if positive MPV, accept. Negative MPV, reject. As simple as that. All right. Then sometimes after that, the question will also ask you something like that. And then you give a recommendation, or they will just ask you to discuss, okay, on the answer that you get, and explain your justification in support of your recommendation. This kind of question is basically asking, yes, what you have calculated is positive NPV, but what will be the potential problems if we based on that? I mean the answer you calculate, this one. The answer that you calculate positive NPV, 43 million this project, good project. But can you recommend me some things, any suggestions or any things that I need to look after? Potential risk of these figures maybe? Then that one is up to you to explain. Like this one, you can see the formal answer. Formal answer is saying that from the 43.31 million positive NPV, it seems like it's financially viable. It means that financially it's profitable when we can earn money. But it is a new technology. If you remember what you have done for your midterm, okay, what you have learned for the project specific cost of capital, you see, therefore the assumption of brilliant risk profile remain unchanged may not be appropriate, and adjustment cost of capital may be required. Okay, this one is coming from here. Risk profile. There's an assumption saying that it will be the same one. This one. You see? With this new investment, its capital structure and risk profile will remain unchanged. There's an assumption. With this assumption, then we can use back just now whatever we have calculated for the WACC is the existing WACC of this company. Because we assume that after this new investment, business risk remain the same, capital structure remain the same. So we can use back the same WACC. But what you have learned, you should know that This one is a brand new, totally new investment, new technology, you know. So which means that supposedly after you invest into something new, what will happen to your KE if you remember what I said, your KE will change one because your business risk is no longer the same like previous. So supposedly you cannot use this existing WACC anymore. But this question still using the existing WACC because it assumes that we remain unchanged. But with the new technology, there should be some changes. So here, former answer saying it could be a problem. We should consider that the discount rate we are using, this 10%, what we have calculated might not be accurate. We should use a project-specific WACC to be more proper. So this is the point. If you can extend something like that in your exam, that is fantastic, which means that, you know, when you read the question, you have that kind of fundamentals in your brain. You will know, hey, this one something's wrong, and you can point out, something's wrong, this one need to be careful. This one you are using the existing WACC might not be a correct one, even though it's based on the assumption saying that will be the same, but realistically it might not be the same. So this one need to look after, need to be careful. Okay, and second thing, you can also say that, another thing is because, as you know, NPV based on all future cash flows. This one is from year 2 to year 11, you know, 11 years later. Can you estimate everything correctly? And same thing, you also can point out that you assume from year 2 to year 11, all the sales will be the same, will not drop. After with the competitiveness, all these things, this one will not drop. It's like too linear already, too simple, the estimation. You also can mention here, the forecast, the cash flow might not be accurate. Maybe the competitors will find even more superior technology, so your sales maybe after 5 years will drop a lot. But here seems like you assume it's the same. It's also something that worth to point out. Okay, but again, in the real exam or at a higher level, it sometimes really depends on how you justify the answer, and a lot of times will be from the questions. This one is very hard for me to teach because again, is your fundamental, is it strong enough for you to, when you read the question, then you will be able to see the problem of this question. Okay, whatever we are applying, anything's wrong with that. It's very hard to teach this one step by step. It's open-ended actually, but your explanation, you must have the point there. You must have the point, and that is reasonable. Like this, I would say that this one is 4 marks. If I see this kind of answer in the exam from student, 100% I will give 4 marks because everything here seems to be very reasonable. It's valid, the answer. First thing, definitely, if you can explain something like that, it already leave a very good impression to the marker, I can tell you. Because from here, if you can explain something like that, which means that you have that kind of knowledge. Okay, you know that using existing WACC for a brand new investment, something is wrong. You point it out. So we need to recheck. Second thing, you talk about the accuracy, because everything is forecasted, and it seems like too linear, we call that. Wow, it's like so simple, one every year same for the 10 years. It could be due to competitiveness, all these things if you drop. Okay, but here it's not like question 2, you cannot talk about inflation. You know why? Because here is already telling you in real terms. If your answer, you follow question 2, you say that, or maybe we should also consider inflation in here. That wrong. Because I already informed you it's real terms. Here is not that I do not consider inflation. It's that I'm using real cash flow. I have already excluded all the inflation out. So if here you are telling me in the answer, you say it's like question 2, you follow the answer, or we should also consider the inflation. Maybe due to inflation, if you increase, 0 mark. That's why you see, don't simply go to copy paste the answer and assume that every case you can apply the same thing. It is different one. Because from your midterm, I know some of the students, they just simply copy paste, from the tutorial paste into the midterm. But the case actually different. Not everything can be applied 100% the same. Just like this one also the same. You see, just now question 2 asking you, and then here is saying that the constant selling price variable cost you do not include the inflation something is wrong. Because here seems to be already nominal, you know, but you do not include the inflation. But this one is real cash flow, already inform you, it's a real cash flow. So it's not that we do not include the inflation, it's that we purposely excluded that. We are using real cash flow, nothing wrong on that one. So you cannot comment on inflation. If you want to say, you can say, you still can say it cannot be too fixed because of competitiveness, all these things. All right, but this one takes time not so easy. Okay, Johari, good idea. Can, no problem. You can also use your table A3. What Johari means is, you go to the table A3. Just now the figures, you also can from table A3, you sum from year 2 here, you add until year 11. From 0.8264 add 0.7513, add until 11. Also can, you get the same answer. Can, no problem on that. It's up to you. Any more questions before we end the class? Actually, I think you also notice, if like year 11, you add everything, table A3, you add from year 1 to year 11, you add everything, that one will be the annuity figures for table A4 for year 11. Okay, if you have no question, I think that's all for today. You can wait for your midterm.